suppose we have invested and now the startup has gained some valuation, which is probably 2 times, 3 times. So during the exit, how it works? I would like to understand that process. So why this question comes to my mind is, suppose during the next round, the founder of that company has something in mind. Suppose they are raising another 10 CR or 12 CR. So they are diluting some percentage from that. But at the same time, if somebody wants to exit, then how do they calculate that and how that works? So if you kindly provide me some guidance on
Okay.
that.
So let us take an example of a angel investment first round. Say the company is valued at 10 crores and they are raising 10% dilution and let's say 1 crore. Okay. So for 1 crore, they will be diluting 10%. Total company valuation comes out to be 10 crores. And now let us suppose you bought 1% of the company by investing 10 lakhs, right? So I'm just trying to make it simple. So you invested 10 lakhs at a 10 crore valuation and you got 1% of equity. Now, pre-money and post-money valuations are different. So before they were raising, they were valued at 10 crores. After the fundraise is completed, it will be 10% appreciation automatically in the entire valuation of the company because of 1 crore which is added, it will be added to the valuation of the company. So now pre-money valuation was 10 crores, post-money valuation will be 11 crores. So automatically just by investing, you gain 10% appreciation on your equity of 1%. So you invested 10 lakhs, it became, may I request you to stay on mute? Till, okay. So your 10 lakh appreciated because now the company's valuation is 11 crores, not 10 crores. So it appreciated by 10%. Your 10 lakh became 11% just after the investment happened, the round completed. So that is the first gain, which is a notional gain as of now because you are not exiting right now. Now let us suppose second round happens at 20 crore valuation, generally which happens, and third round happens at 30 crore valuation. And in the third round, some investors who are buying the equity at a valuation of, say they also take 1% and they have to pay 30 lakhs for 1% now. So that moment, existing investors who have participated can come and in the secondary, they can sell off their equity for say 20 lakhs. So incoming investor got 10 lakh rupees benefit. You got 10 lakh rupees benefit. It is a win-win for both. And it does not mean that you have to sell it off for 20 lakhs. You can sell off for 25 lakhs also. Both the parties should be agreed, right? And there has to be some discount at the current valuation offered by the company. That is why they will be attracted to buy from an existing investor. Kumardeep, is that
Okay,
clear?
yeah. So that means there is a option provided to the investors, to the previous investors, and then they can go for a assumed valuation or a price, and there should be a negotiation happening. It's like that. Okay. Okay.
So
Thank you.
there are two methods here also. Sometimes the company offers a buyback themselves, right? Before going for the next round, they offer a buyback, and they will be like we did 2 exits. One exit was for experiential ETC, 6 months. Company offered buyback before the next round. Similarly, Talent Gum, in just 2 months, company offered the buyback to the existing investors, and investors made 50%. But that does not mean that all the investments will fetch 50%. This is just maybe by chance that it has happened, but we are expecting it could be more, it could be less. Generally, we suggest to the founders that if you have to buy back, at least buy back at 50%, so that the deal becomes so much attractive for the existing investors. And I'll tell you why it happens. Initially, when the company is new, they will have many investors of small ticket, and they have a limitation of, by law, they have a limitation of 200 total investors or shareholders, 200.
Okay.
Till the company is private limited, unlisted. Then in case they have to receive bigger ticket funding and the existing investors are not interested in putting in more, they need to give exit to the existing shareholders so that they can take funds from the bigger ticket investors who are coming at a higher valuation. So nobody can be stuck. If the company is growing, they have to constantly raise funds and they have to give access to the existing investors. By giving them exit, they can have a clear cap table. On the capitalization table, few names should depict, not more, because they need to accommodate incoming investors. More new investors wants to come.